Hey, friends. Dan Passarelli here. How are you feeling today? I hope you're feeling good. I'm feeling good. I hope you're feeling good too. First of all, I want to make sure you can hear me. So please head on over to the questions box. And if you can hear me, say puts. Say puts, not putts, puts. All right. Puts, putts. There you go. Thanks, Ben. I was talking to a friend of mine who doesn't know anything about options and or what I do or anything. And she's like asking about his like options. She's like, "Oh yeah, I read about that. It's puts and calls, right?" It's like, no, it's not puts and calls. It's puts and calls. All right. Thanks, friends. So today what we're going to talk about is puts versus stops, and how to best protect your long-term investments. Now, before we get started, I need to point out that options are not for everyone, and you need to read characteristics and risks of standardized options before trading. And you can get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And what we're doing here today is giving general information, and not information specific to your personal situation. Now, I just saw a lot of names of friends who've been attending these trainings for a while now. I've been doing this for a few months, and it's great to see you. For those of you whose names I didn't recognize and might be new to these weekly trainings every Tuesday at this time, noon Eastern time, allow me to introduce myself. My name is Dan Passarelli, and I am an author of two trading books. I've been part of a couple few others, and I got a new one in the works. And like hundreds of articles and videos and blah, 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 blah. Been doing this a long time. And I'm a trader. I trade basically every day. I used to trade professionally on the floor of the Chicago Board Options Exchange, CME Group, Chicago Board of Trade. Been doing this a long time, over 30 years. And I am the founder of Market Taker Mentoring, which is the leader in option trader education. And I am a trading industry collaborator. I work with some of the best options brokers in the US and abroad, including and especially Firstrade, as well as many of the exchanges in the world, maybe all of them at some point. I don't know. It's hard to say. At least on some level, I've at least been part of something they do. And, software companies, whole nine yards. And I have a family. I'm a family man. My wife, Kathleen, my two adult children, my two cute little dogs. And I do some things for fun besides trading. Trading's fun, but I'm a runner, foodie, traveler. Me and my family and John Kamisik that I work with, been all over the world together. Me and my family are music people, both in playing it and listening to it. So that's me. Now let's talk about the important person here, you. So we are going to talk today about you being able to protect your long-term, medium-term, even short-term investments and even trades by using either protective puts or stop losses. And if some of these things are new to you, what I'd like to do is get you a free class on it. All you have to do is go to markettaker.com and just click on either here, join free, or up here, join free. And we've actually got a free class right here, the options risk analysis training course, which is for people who are new to options. Um, it helps you understand basically what an option is and how to draw profit and loss diagrams, which is if you're new to options, the best way to learn them is to do it the old-fashioned way. Get out a pen and a piece of paper and draw it out. Because if you can do that, then everything else makes sense. So start there, and you actually get access to all the things under the fast track section here as well. So lots and lots of free goodies for you. All right, let's talk protective puts and stops. We always want to control our risk. As far as trading goes, like active trading, there is this is probably rule number one in trading. Cut your losses fast and let your profits run. Who here has never had a losing trade? Raise your hand or give me a yes in the Q&A box. Who's never had a losing trade? Oh, look at all those hands and yeses. You'd be a liar if you did that, unless you've never made a trade, or maybe you just made one or two and they worked out. But we've all had losing trades. I've made like 50,000 trades in my life. That is not an exaggeration. I've been literally doing this for over 30 years. So you can rest assured I've had tens of thousands of losing trades, tens of thousands of winning trades too. Um, you're not going to win on every trade. And so if your losers are small and less frequent compared to winners being bigger and more frequent, you've got a recipe for success. That is everything that works, or everything you need to make it work, I should say. So when it comes to trading, risk control is everything. And of course, there's two parts to every trade, right? Part one is giving yourself an edge and putting on that trade in a smart, risk thought out thing, right? And the other is managing the trade and making the risk smaller, as small as possible. Risk control is everything, but how do you control your risk most effectively? And that is what we're going to talk about today. Catherine, hey, Catherine, how are you? Catherine says, I had a lot of losing trades. That makes me even more interested in learning and trading. I know. I'll tell you what, losing trades can be a gift. You know why? Because it helps us learn. Now, to be fair, the market is the most expensive teacher and the worst teacher because they don't tell you what you did wrong. You just have to try and figure it out. And sometimes you don't know. And sometimes you didn't do anything wrong, but the market doesn't tell you, hey, you just had bum statistics. You actually traded it the right way. Market is a terrible teacher, but it's good to piece things together. I was just talking with our head coach, John Kmisik, and we were talking, basically about this fundamentals, going back and looking at trades, some of ours, some of our students, some other trades. We have a scanner that gives us credit spread trades and wing spread trades and time spread trades, and that are made by professional traders, even 0-day trades. And like going back and piecing it together, like, why did this trade work? What was the criteria that this trader must have looked at, or the criteria that I looked at? You learn a lot from doing what I just call a post-mortem on the trades. I remember talking to somebody about that years ago. He's like, post-mortem, what? Is there like a dead body or something? Well, no. You call it whatever you want. But learning from mistakes and learning from successes. So, Catherine, I love it. Okay, so one way to control risk is with stop losses. So, a stop loss is in order that you can put in Now, where if a trade goes against you enough, you get stopped out. You sell that so that you sell um, to take a small loss instead of let it become a big loss. And you want to know the hardest thing about all of this? You want to know the hardest thing about all this? Psychology. It is very difficult for honestly almost anybody to be happy taking a loss when you first start trading. After you've traded for a while, it becomes easier because you know that's part of the game and you're happy with it. But, there are certain heuristics and biases that the human brain has. One of which is being the recency bias, where, you say, okay, Passarelli told me that I should, uh, sell my losers quick. So I'm going to sell this and take a small loss. And then all of a sudden the stock goes back, which is called a whipsaw. And oh, if I would have held on to it, I would have made money. Right? That's the last trade you saw, the most recent trade. It's called the recency bias in behavioral psychology, behavioral economics. And you think, oh, I shouldn't have done that. Okay, you make 100 trades and do the same thing, and then you know if you should or should not have done that. So we're going to set a stop, and we could take a look at, we could take a look at this. Catherine, what's your favorite stock to trade? Anybody, what's your favorite stock to trade options on? Uber? Uber. Good choice. Okay, so Uber. Where's Uber trading, first of all? Hold on a second. Uber. Let's first get our bearings here, shall we? Oops. Hold on a second. I got to get used to the new layout here. There we go. In order to make things better, you have to change them. But sometimes when things are changed, you have to adjust to it. So Uber right now is trading at 77.80. Okay, so now we can go to the options. And let's say I bought just right now the 77 calls. Well, in fact, let's take a look at an option chain. Let's say I bought, when Uber was a little bit lower, I bought the 76 calls and I bought them at $2. And now I'm thinking, okay, I have a profit and I want to keep that profit. Or maybe I just buy the 77 calls now. This is a better example. Let's say I buy the 77 calls now. Okay. And I buy them at, I try and middle the market. I get filled at $1.86. Okay, so now that trades on. So now I want to protect it. One way to protect it is I could click on the bid to sell, right? One contract, 77 strike call, expiration 2/14. And I set a stop order to sell at what? If I bought these at 186, would the stop price be above 186 or below 186? Remember, this is to sell to take a loss if and only if it goes against us. Do I want to take a loss? No, I want to have a profit, but I can't make that happen. Stock could go up, could go down. Who can be first with the answer? Who can be first with the answer? Is the stop price on this call that I currently own at 186 going to be higher than the strike price or lower than the strike price? Powell says lower. Captain Orion says below it also. Good. Ken, lower than the strike price. You guys are doing great. You guys are awesome. Alan is right on the spot. Great job. Okay, great job. So that's right. It's lower. So I might put it in at something like 150. I could make it a day order or good till the next 90 days. I could do all or none, or I could just leave no instructions, which I would typically do. So what does this mean? Okay, this means if the stock goes up and the call makes money, that's great. I can take my profits at a higher price and I'm happy. I do my little happy dance after the trade, go and spend that money on something frivolous, or let my account grow. Or the bad thing happens, the stock goes down, and if the call trades at or is offered at $1.50, we put in a market order to sell the call. Now, why not a limit order? Well, because a limit order can be tricky. If I put in a limit order to sell at $1.50, if it's offered at $1.50, well, then it's going to put it in order to sell on the offer, which won't get filled unless the stock goes back up a little bit and I can miss my stop. So me personally, I don't really like to use stop limit orders very often. So that's how stops work. Okay. You guys are doing great. All right. Where is my thing here? So like I said, it triggers if the option trades at or is offered at the stop price. Okay. So stop orders work great when they work, but there are a couple of problems with stop orders. One is fast markets. What happens when all of a sudden, there's a Fed meeting and the Fed says, oh, we're actually raising rates 0.25%. Wait, you thought we were going to cut them? And then the market says, oh no, and goes crazy. That's called a fast market. Well, your stop can get triggered anywhere because there could be big gaps during the day or overnight gaps. I mean, overnight gaps are very common. They happen, geez, like a lot of the time, right? That'll mess up your stops too, because like what on that last example, what I had it in order to sell it at $1.50, right? Well, what if Uber gapped way down and that call opens at 50 cents? Well, it's not trading at $1.50. If it trades at or is offered at or below $1.50, it's going to trigger. So I'm going to end up selling it at, 50 cents or 45 cents if that's the bid. So stops can have some trouble. And like, look, here's a perfect example of how this plays out, right? So here you're looking at this stock chart and, oh, look, we had some support. It bounced off support. This is great. I'm going to buy the call here or buy the stock here. It doesn't matter. So it goes up. I'm right. Takes a little bit of a pullback. We're like, oh no, but we ride it out. And oh, hey, man, everything's happy. It's sunshine and rainbows and unicorns. This is wonderful. And then, uh-oh, it gapped lower. I'm kind of getting nervous here. Um, hmm, I better put in my stop. Now, to be fair, by the way, I like the idea of putting in the stop as soon as you make the trade. Okay, not waiting until you're getting nervous, but as soon as you make the trade. But either way, so now I'm getting nervous. And so what do? Well, I enter a stop to sell, let's say I own the stock, to sell it at 31.50. There's support there. If we get down to that level, I just want to sell it. But then you know what happens sometimes? It gaps lower the next day. I get filled at 29.10. Wait, but I had to stop to sell at 31.50. Well, it never traded or was even offered at 31.50. At the end of the day here, it was trading at like 31.95. And the next day it opens at like, 29.19 or something, wherever it was, 29.10. So that's a problem with stops. And then, oh, it starts going back up. So I get long again, but that doesn't work sometimes, right? Then it goes back down. That's called a whipsaw. So these protective puts are something that can help solve that problem for us. So here, instead of using a stock, we buy a put. So the put guarantees a selling price because you have the right to sell at the strike price. You have the right to sell it there. If it gaps, doesn't matter. I have the right to sell it here. So like if I'm long a stock at 82, I might buy the 82 strike puts at say $3. So this is if I own the stock, right? If it goes up, happy dance, rainbows, unicorns. If it goes down, oh no, right? So how do I solve that problem? Well, if I buy a put to sell it at 82, then the most I can lose is what? Well, if it goes down below 82, I won't lose anything on the stock, will I? But there's a little bit of a trade-off. I will lose what I pay for the put. We can think about the put as insurance, right? I mean, it is literally like an insurance policy. I can't say it's literally insurance policy, but kind of is. When you buy car insurance, if you don't crash your car, you lose whatever you paid for insurance. So logically, you're mad, right? Why I should have crashed my car so I could have cashed in on that insurance. No, that's not what you're thinking. You're thinking, shoot, good. I crashed my car and it cost me, whatever the premium is every 6 months. Well, that's kind of how puts work. If I pay $3 for that put, well, first of all, if it goes up, I lost $3. It actually has to go up above 85 in order for me to be profitable. If it goes down, well, I have the right to sell it where I already own it, 82, but I paid for that put, so the most I can lose is $3. If it goes down more than $3, fine. If it goes down up to $3, then I have limited loss. I still have unlimited profit potential. So looking at this, I want to quiz you a little bit here, okay? I want to quiz you. I like to see how much people are paying attention. Where am I happy I bought the put? There's 2 points. Basically, if it goes above a certain point, I'm glad that I have the put. If it goes down to a certain point, I'm glad that I had the put. And if it's in the middle, uh, you know, in hindsight, the put didn't help and I lost, some money on it, but I got to sleep at night. Stephen says 79 and 88. Let's explore that. So, yeah, here, if I own the stock at 82 and I have the right to sell it at 82, if it goes down a buck, well, then I lose $1 on the stock, right? But I get to sell it at 82, so I make $1 on this. Actually, I don't lose anything on the stock, right? You can look at this two ways. Let's look at it this. I exercise the 82 put, so I don't lose anything on the stock, but I do lose the $3. So, we can think of it as a little bit of a bummer, but it's the same bummer as not crashing your car. Like, I got to sleep at night. Everything's cool. I knew what my loss was going into it. You know, if I could wave a magic wand and change the past, okay, I wish I didn't pay for that insurance and just took a chance on crashing my car, but whatever. If we go down more than $3, though, then that's where I'm protected because that's where I would actually lose more than $3. So 79 is correct there. As far as to the upside goes, I mean, you can kind of make a case for a couple of different things, right? I mean, first of all, if it goes up like a buck, well, I'm going to lose, let's see, if it goes up a buck, right? I'm going to make $1 on the stock, but I'm still down $3 on the put. If it goes up $2, I make $2 on the stock, but I still lose $3 on the put. If it goes up $3, I make $3 on the stock, but I lose $3 on the put. I mean, you can make a case for saying 85 if it's anywhere above 85, so basically between 79 and 85. You'd probably want a little more to feel really good about it. Like, hey, if it goes up to 90, then I'm like, oh, yeah, I don't care about that darn put. So if you think about it, this solves some problems. It solves the gap problems, whether those are intraday or overnight gaps. And it also solves the guessing game problem. Where should I put my stop? Should I put it in at 79? Should I put it in at 81 and a half? Should I put it in at 77? Where should I put it in? This, I know what my maximum loss is going to be. It's going to be $3. And I'm paying for that out front. And psychologically, it's way more easy to get over that. Like, I'm going to pay the $3 and I'm protected. I'm done. I'm out. Right. Whereas if I put in a stop, oh, now I could get whipsawed, oh, blah, blah, blah. And we'll talk about that in a second. Robbie says, what is the best strategy to use for day trading? Buy a call with stops? Yeah, okay. I'll digress for a second here. A little off topic, but maybe not really. So I actually literally was just talking with somebody earlier today about this exact topic. Um, it's hard to day trade with options. Because most options bid-ask spreads are just too wide to day trade. Like, sure, sometimes you can get filled in the middle of the bid offer. And if you're trading SPY, maybe even SPX, the Qs, Apple, Tesla, they have pretty comparatively narrow bid-ask spreads, and you can usually middle the markets. And you might be able to day trade with those. But there's probably no more than 10 stocks or ETFs, a universe of 10 stocks or ETFs that you could even day trade options with. Otherwise, the commissions and the bid ask spreads just eat away too much of the profit. It wouldn't work. But if you are, so I would say if you're day trading, it's usually better to do the stock. But if you're trading some of these really, really liquid names, SPY, SPX, Apple, Qs, then you can do that. Either way, if you're day trading, you probably are not going to want to do puts. You could do puts with some of the indexes or ETFs that have 0-day options listed on them. There's not many of them. There's a handful. There are no stocks currently that have expirations every day. So you probably are not going to be able to use puts for most of it. You're probably going to have to use stops. Now remember, there's two types of gaps that are a problem for stops. Intraday gaps that happen during fast markets and overnight gaps. Well, with day trading, there's no more overnight gaps. So you eliminate one of those risks. And that one's the more common, more frequent, and bigger risk. Only when there's a sudden, unexpected, what we call a fast market, is the intraday gap a thing. So, I mean, for day trading, you're probably better using stops with trading the shares most of the time. And Catherine, what if instead of buying the stock, we sell a put with an 85 strike price for $3? We'll either get the stock for 82 or keep the premium. Catherine, I like the way you're thinking. So there's two types of way to hedge stock with puts. And we're kind of splitting hairs here now. One is called a protective put and one is called a married put. Technically, a protective put assumes I already own the stock. So this is probably more likely to be a longer term investment. And no, not necessarily. It could be a shorter term trade if you swing trade with stocks. Now, swing trading, I like trading with options. But yeah, so if I already own the stock, then yeah, I'm going to buy a put. But if I bought the stock and the put at the same time, that is called a married put. Now, the timing doesn't change the profit and loss diagram here. It always looks like this hockey stick shape. But do you know any other option position that has this same hockey stick shape? A long call, right? So yeah, I mean, actually, if you bought the 82 call for $3 and didn't buy the stock or the put, it would look almost exactly like this. So you would actually use the same strike price to have this same risk profile. If the stock's at 82 and you bought the 85 strike call, you'd be able to buy it for less than $3. But then it has to go above 85 plus whatever premium you paid for it. So I like the way you're thinking, Catherine. You're looking at the whole picture, thinking about synthetics, right? That's basically what that is the synthetic relationship. Brett, I own a stock for can you explain this stuff? Brett, that all right. Some of this you probably want to talk to Firstrade about because I'm not I am a guest here speaking on behalf of Firstrade, not a Firstrade employee. But let's talk to this part of the question. What's the difference between a stop and a trailing stop is what that is generally called. So this is a classic stop. There are some organizations that offer trailing stops, which is where usually for me, if the stock went up and I had a profit, like maybe it went up to 85 and I only own the stock at this point, then I would buy like the 84.50 trailing stop, which means the stock's at 85, trailing stops at 84.50. That's 50 cents apart. If the stock goes up a penny, the stop goes up a penny. If it goes up a nickel, stop goes up a nickel. If it goes up $1, stop goes up $1, but it always stays 50 cents below. So if it so if it's at 85 and it's the 84.5 stop and it goes down to 84.75, the stop still stays at 84.50. So it's like a check valve in plumbing, if you know what that is. Anybody has a sump pump has one of those, a check valve, where basically the water can go this way, but it can't come back down this way. So the stop moves up, but it always stays. Oh, I got off the screen there. The stop moves up with the stock but it doesn't move down with the stock. All right. Thanks. With a short put and call butterfly work better for, oh my goodness. Robbie, let me get back to that one. Let me get back to that one. Otherwise, we'll get off the subject here. Okay, so here's and I'll get back to it in just a couple minutes here. I just want to finish this part. So here, let's say we have protective puts, or no, we have the stock and we bought puts on it. Okay, we did it as a married put, which to Catherine's point, we could just buy a call, but so we bought it. And same thing happens. Oh, we're doing great. Oh, had a pullback. Oh no, we're back to doing great. Oh no, it's going back down. Oh geez, I don't know. I'm getting nervous. So I could buy the 3150 puts. Now, kaboom, it goes down to 29.23. Well, that's okay. I didn't have that gap problem, first of all. I have the right to sell it at 3150. If it goes back up, good. I want it to go up. I'm still long the stock. If it goes back down, I don't really care because I can sell it at 3150. Anything below 3150, it doesn't matter at all what happens. So a little bit of a, oh shoot, Ravi, I just deleted your question. I'm sorry. Would you mind asking it again? It was a good one. I just couldn't answer it at the time. I apologize for that. Just type it in again. So stops. There's no price guarantee. If you get a gap, you get a potentially lousy fill. If it gaps down, starts running up and you get back in, you run the chance of a whipsaw. And an advantage is that there's no cost to putting in a stop order. With protective puts, the price is guaranteed. You literally have a contract that enables you to sell the stock at a fixed price, the strike price. Therefore, no gap worries, no whipsaw worries. But those two benefits, price is guaranteed, can't get whipsawed, you pay for that benefit. So which is better? Well, neither is really better. It depends on your situation. It depends on your perception of the risk. It depends on exactly what you're doing. Like, who is that earlier? Was that Robbie that asked that about day trading? Like, I usually would not use puts with day trading. I do like trading zero DTE options, but not necessarily for hedging day trade. I don't really day trade, I'll tell you the truth. So which is better? Neither is universally better. If I'm a day trader, I'll use stops. If I'm buying call or buying put, I'll use stops. If I own the stock, more often than not, I'll use puts. What else was I going to say? Yeah, that's about it, I guess. Yeah, it'll come back to me. Catherine says, with trailing stops, what percent of trailing is the best for stocks? And what is it for options? Oh, I remember what I was going to say. One thing is I never want to use stops with spreads. Let me repeat that. I never want to use a stop order with a spread. Why? Because remember, a stop order triggers when that position trades at or is offered at the stop value. First of all, the spread might not ever trade there or below there. So it's only offered there when the offer of this one and the bid of this one is the natural offer. So then it will sell it on the bid, which is the bid of this one and the offer of this one. Because remember, you're always buying one and selling another. You're always buying the one on the offer and selling the one on the bid. So it triggers at the lowest possible time, and then it sells at the worst possible price. Because remember, spreads have two bid ask spreads. If one option is this wide and the other is this wide, the spread is the sum of those wide. So you get terrible, terrible fills with spreads if you use stops. Would I use a protected put on a spread? Well, no, I would not. Um, with spreads, that's a completely different thing. With spreads, I plan what is my maximum risk here, and I'm okay with that. And what's my maximum profit? And then I set a profit target and usually put in a GT90 order um, to take my profits on the spread because I don't care if I get filled at the worst price, the middle price, the best price, it doesn't matter if I'm taking a profit. And as far as losses go, I will either find a way to set some sort of alert if I have that capability, or I'll just look at it a few times a day. And if it gets, through a certain value, I'll close it. It depends on if it's time spread, credit spread, debit spread, or whatever. Good questions. Catherine, with trailing stops, what percent of trailing is the best for stocks and what is it for options? Well, I don't use a lot of trailing stops because my investing is with stocks and sometimes with, turn those into covered calls or cash secured puts. So that's my investing. So I don't really use trailing stops for that. For options, I'm usually using spreads. So I don't do a lot of that. But when it comes to trailing stops, there's two parts to the life cycle of the trade. There's the beginning of the life cycle of the trade where you need to let it have enough room to the downside to breathe, right? Because as soon as you put on a trade, as soon as I buy a stock, I mean, 50% of the time it's going to go up a bit, 50% of the time it's going to go down a bit, right? I mean, unless you've got some amazing, system for playing very short-term momentum, and that's great if you do. So I would just use a regular stop in the beginning, and then I would put in, like, once it reached a certain profitability level, I would cancel that stop and I'd put in a trailing stop. And I would probably put it in a very, very small percent. Um, 0.5%, maybe. $100 stock, 50 cents. It's about right. $10 stock, 5 cents, about right. Because I would only put it in when I was happy with the profit I had already, or put in a trailing stop on half of it. As far as for options go, I'm only going to be using even a stop if the markets are very, very tight. So as far as a trailing stop goes, because the bid ask spreads are percentage wide, much wider than they are for the stock, I'm going to make them a little bigger, maybe 3 to 5%. But I definitely only be doing that on very, very tight markets. Okay. Good questions. Good questions. Ravi, again, I accidentally deleted your question. If you want to throw it back up there, please do. I definitely apologize. Okay. So you are welcome, Catherine. So at expiration diagrams, which were basically those hockey sticks that I was drawing, they don't really tell the whole story all the time. I can sell a put Oh, I can sometimes I can sell the put after the event has passed. I don't those hockey sticks, those are what happens at the expiration of the option. But I'm not going to buy a put on every stock I trade. I mean, the value of, I mean, here, look. So Uber, what I say, that's trading at 77 bucks, right? Well, I can buy the put at $1.88. And this is the 14th. That, what's today's date? This is a 3-day put. I'm paying like 2.5% for 3 days of protection. Geez Louise. I mean, if I did, what's today again? The 11th, March 14th, so a little over a month. Here I'd pay about 5% for a little over a month of protection. A little under 5% for a little over a month of protection. If I spend 5% a month, I lose 60% a year if the stock keeps going up. So we really only want to use puts pretty selectively. Um, so maybe, there's earnings. I mean, the problem with that is puts get much more expensive going into earnings. So we got to get the timing right. You got to be really careful. But if there is some reason that I think there's more risk now, the stock could drop and I could buy the put at a favorable price, and I'll do that. And once that event has passed or the news came out or whatever it is, I'll sell the put. And if the stock went down, I'll sell the put and take a profit instead of um, exercising it and selling the stock at the strike price, because the profit on the put offsets the loss on the stock. Now, depending on how your statement works, like, it'll always show like, oh, you're down money on the stock, but you just have to remember or keep a good spreadsheet. Yeah, I'm down money on the stock, but I made that money on the put. That's a better way to use puts and manage your hedges. And then the cost of protection can be pretty negligible if you're not holding the put all the way until expiration. All right. Any final questions before we call it a day here? Any final questions before we call it a day? Aha, Steven says, do you close multi-leg options before expiration? The last Friday the call was assigned. Yes, almost always. If it's a 0DT trade on a cash settled index, no, I'll let those go at expiration. If it's a very, very short-term trade with like a very, very wide iron condor or something, I'll let that go at expiration. But 98% of the time, yeah, I close multi-leg options before expiration because at some point the risk reward is no longer worth it. At some points, like, I have this profit, and I can only make this much more profit, but if it goes against me, I can lose all my profit and then turn it into a loss. So yeah, I almost always close multi-leg options after expiration. Lesson learned, they assign short stock. Yeah, I know. Yeah. Assignment is part of that answer for sure, but so is the risk reward. Think about it that way. Because remember, whatever, like if it's a credit spread, the most you can lose, you can still lose, even though you have the profit. But the most you can make, you don't think about it from like, oh, I sold this credit spread at 75 cents. If it's now trading at 4 cents, well, now the most I can make from this point forward is 4 cents. But I still have all this risk if there's a crazy surprise. So good question. I love when I get asked that question because I have a very decisive answer on it. Michael, Thank you, sir, for your time and expertise. You're welcome, my friend. I learned a lot and I'm new to options, so I appreciate it. Awesome, my friend. Well, good, 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 good. All right. Well, that being said, folks, have a great rest of your day. Thank you for sharing your time with me and allowing me to share mine with you. And I will see you next Tuesday. Trade smart. Catch you next time. Bye.